Okay guys, so today we had some really important news that came out of the European Union, with the European Commission signaling at the end of this month in May, they're going to reopen travel and tourism across Europe. So this is going to give us some really good trade ideas for buying stock market indices across Europe and trying to benefit from some companies that are going to profit from the reopening of travel and tourism. So countries like Spain, Italy, Greece, they rely on travel and tourism for their economic growth. And with the summer season coming, the European Commission wants to help these economies get back on their feet because the COVID-19 pandemic has really hurt these economies quite badly. So this will give us a lot of trade ideas, which I'm going to share with you in this video. We're going to look at buying European stock markets. We're going to look at some individual stocks of companies that will benefit from this reopening trade, such as Easyjet Airlines and other stocks that we can position in now because their earnings are going to go higher when people start flying, traveling, so on and so forth. Also, the European stock markets will just generally move higher once people start spending again and travel restrictions are eased, and this should give us a lot of trade ideas. So we'll look at stock markets, oil as well as another good trade, and some individual stocks. And this is the kind of information I'm giving to my members, and in the free analyst channel I do provide on Telegram. So if you watch this video and you like what you see or you want to learn some more, come and join my free channel on Telegram, or you can join my premium service, or just come and watch the service and the free material I provide every day, and just get in the habit of understanding how people are investing and making money in the market. So watch the video, hope you enjoy it. Got any questions, ping me a message and I'll be happy to answer your questions. Thank you. Okay guys, so welcome to today's video. We're going to have a look at the European stock market indices, the Stocks Europe 600. We're going to look at the German 30 DAX index, and we're going to look at oil prices, which are all likely to get a boost from the news that the European Union is going to agree to try to open their borders by the end of this month, May, to try to help the travel and tourism industry and countries such as Spain, Italy, Greece that do benefit from European travel and tourism. So this is really important because the European economy will get a boost from spending from people traveling across the Euro area, and that should improve the economic outlook of these countries within Europe and then help their stock market indices to push even more higher in the markets based on growth and inflation expectations. So we've seen the German 30 stock market index making strong gains from the sell-off last year. We've seen a really strong appreciation in price. It's now up 12% from the beginning of the year for the German index. And then if you look at the European stock market index, we've also seen strong gains since the bottoming of the stock market sell-off last year, and by the beginning of this year we are currently up not as much as the German stock market, but again it is in a positive territory in terms of growth within the European stock market as well, currently up around 12%. So we know what's been causing the stock markets to go higher in Germany and the European Union stock markets because of the leading economic indicators that predict growth in GDP. So just remember guys, the companies within the European stock market or the German stock market, the earnings of these companies is what makes GDP. Remember, GDP is just a total value of everything being produced by companies and businesses within a country over a certain period of time. So for an example, over a 12-month period or over a quarterly period. So why we look at the manufacturing and services data in these countries and why these leading economic indicators have been causing the markets to buy the stock markets even though there's been lockdowns in Europe is because we are expecting growth in the manufacturing sector, which makes up around 20% of the European Union, and we've seen growth in the services sector, which makes up around 80% of the European economy. And remember, when you have growth in the manufacturing, so when there's about a reading above 50, this means that we're expecting positive prints in GDP, and you can see GDP highlighted here in red, and then you can see the manufacturing highlighted in blue. And as you can clearly see, when manufacturing is above the level of 50 and growing, we are predicting that there's going to be growth in the manufacturing sector, which makes up 20% of the economy. So investors are going to be buying these stocks of the companies within the manufacturing sector because they're predicting higher earnings for these businesses. And as the higher earnings do play out, you get positive prints in GDP. As you can clearly see on the right-hand side, GDP goes from around 1.5% to 3% over that 2-year period of growth in the manufacturing. As soon as manufacturing starts to decline and go lower, you see GDP start to decline and go lower. And this is because, again, the manufacturing is, if if the manufacturing is expanding, then the earnings going higher, then GDP is growing, and this means that the stock market goes higher. So you can see between 2016 and 2018, GDP growth was going higher, the manufacturing data was going higher, and there's no surprise that between that 2-year period, if you look at the European stock market, we had a bullish European stock market over that 2-year period because markets were expecting growth between 2016, as you can clearly see here, and 2018. So the stock market went up 35%. Then what happened when the manufacturing started to decline from 2018, GDP started to decline, and therefore investors don't want to be buying these stocks anymore because they're not expecting their earnings to grow, because remember, for GDP to decline, their earnings have to decline, and that's why the stock market declined after as well. So you can clearly see there's a very strong correlation between manufacturing rising over a 2-year period and the stock market going higher. And then when the manufacturing starts to decline, the stock market also starts to decline, because these are the leading economic indicators that are telling the markets whether they should be buying these manufacturing companies, and their earnings are going to be going higher or lower, and therefore GDP will be going higher or lower and following suit. It's exactly the same thing in the German stock market that we saw between 2016 and 18. We saw strong growth in the manufacturing sector. And remember, manufacturing makes up a very large majority of the German economy because they are the biggest automobile producers, such as Mercedes, BMW, so on and so forth. And that's why we saw strong growth between 2016 and 18. You saw GDP in Germany rising strongly. And that is why when you look at the German stock market index, you see the same situation play out over that 2-year period. Similar to what we just looked at in Europe. So we saw, when we zoom out, between 2016 and 2018, you can clearly see the German stock market was very bullish in terms of a very strong uptrend in growth, 55%. So it moved much stronger than the European stock market index. But again, soon as the manufacturing started to decline, we saw GDP declining, and the stock market then declined as well. So we know what we have to look out for. And at the moment, the reason the stock markets are bullish in Germany is because the manufacturing data is above level of 50 and growing rapidly. The services sector, which makes up the other 80% of the economy, is above a level of 50. So we have two of the leading economic indicators: manufacturing that makes up 20%, services that makes up a large majority of 80%. If they're both expected to grow, then we know that earnings are going higher in Europe, in Germany, and then markets are going to be buying these stocks now for these companies to move up their price in expectations of higher earnings. So we can buy the German stock market, we can buy the European stock market based on these forward-looking indicators predicting growth. And more importantly, now that we have the news coming out that they're opening their borders, this will only increase GDP growth expectations even more. So it's very likely that the market is going to keep buying the stocks that are made up within the stock market index. And that should push up the European index even higher. So we can buy these stock market indices right now based on that understanding. Now, obviously we have to look at volatility. So we need to know how much does this fluctuate by on average to make sure that we don't lose on the position if we take a trade. And over a weekly period, it fluctuates by 1.14%. The European stock market index, that is, on a weekly period, 3.69%. On a monthly period, 10.59%. So that's really the stop loss you want to be using, a 10.59% volatility. So that's where, if we are to be buying the European stock market, that is, we know we need to have a stop loss of around 10%. So that would be somewhere, if we was to get into the market now, that would be around here. So at least this gives us the breathing room for the market to move and fluctuate as much as it usually does on average without us getting stopped out of a trade when we're getting into markets. You can clearly see here, when we do get pullbacks, it is usually around the 1-month volatility. So as you can clearly see here, this volatility analysis really does work. So if you're buying the stock markets, that's where our stop loss would have to be. And if you're looking at the German index, we can go across and see that in Germany, the stock market fluctuates by around 13% on a monthly basis. So again, that's where our stop loss would have to be if we jump into a trade now and try to catch this stock market index moving higher in the markets. And again, if I show you 13% and I move it across here, you can clearly see the pullbacks are usually, again, around 13%. So it really does work if we're using this volatility analysis. So we can buy the European stock market, the German stock market, or we can buy the stocks of companies that are likely to see a rise in their earnings. So let's look at Easyjet, the airline that does low-cost travel. Now they're likely to see a boost in their earnings because they fly throughout Europe and do really low-cost flights across the European Union, and their earnings would increase dramatically if this plan does go into place at the end of the month. So we could buy, again, the Easyjet stock price, and hopefully if we can see a breakout of this recent range. We've seen a bullish day in price going up today, but after this news has been released, and if we get a breakout of this recent range, then that's a sign that investors are now buying Easyjet again, because their earnings are likely to rise, and Easyjet hasn't made up the sell-off that happened last year, so there's still room to go with this stock market, with this stock of this company. Also, oil prices. We know that oil has been very bullish in 2021, and we know that's because of OPEC cutting production, but also the vaccination campaign getting rolled out and economies reopening, and that's going to help oil demand around the world, especially for the aviation industry and flying, cars getting back on the road, people going back to work. And the outlook for oil is very bullish. You've got Goldman Sachs saying oil could go back into a super cycle up to $100 a barrel if the demand globally for oil comes back at the same time, which is likely to happen with the vaccination campaign, and this again would move the price of oil higher. And if you look at the manufacturing data in Europe, which you can clearly see, the oil price follows quite closely. So when manufacturing is declining in Europe, indicating contraction in growth, oil prices decline. And then when the manufacturing data in Europe is rising, indicating there's growth in the European Union, the oil price follows closely, because remember, growth means demand is increasing, or contraction means that demand is decreasing, and that's why the oil price and the manufacturing data does move in tight correlation between the two. Obviously, there's a supply element to oil that does have an effect on its price, but mainly the demand will have an impact on the oil price, because OPEC producers will cut supply when demand is increasing to manipulate the price higher so that earnings can increase. But at the moment, we should see oil rising again because the manufacturing data in Europe is very bullish. And if we do this again for the US manufacturing, it's even more of a tight correlation, because the US is the world's biggest economy, and the US economy right now is booming with, I think, $4 trillion they've pumped into the economy already, and that's really picking up growth in the United States. So if Europe and the US is going through growth, then the demand for oil is really going to be coming into play, and that should push the oil price higher in the market as well. And if we look at the volatility for oil, we know that when we're looking at trading the commodity on a month-by-month basis, we know that oil fluctuates on average around 20%, 25% is the average volatility. So if we're going to get into a trade, we know our stop loss is going to have to be around 25% from the current price to make sure we don't get stopped out when markets do fluctuate during a bullish trend. So that's important to understand as well, the volatility of oil. So if you can see here, we had a pullback here. You would be protected if you had a 25% stop loss on this trade. So there we have it, guys. We have a few different trades we could take. Remember, you can come and trade this with me and my members. I'll be sending you video analysis similar to this video every day, showing you what trades I'm taking, why they're happening in the market, so you can learn and also make some money alongside me if you join my team. If not, then come and join anyway and get some analysis and learn to see what's happening and get invested. Now's the best time to get invested, because again, like I was showing you, a lot of these stocks like EasyJet, they haven't recovered yet, so there's still money to be made if you can get in and buy these stocks of companies that will benefit from normality coming back to normal because of the vaccination campaign and the economy is going back to normal. So hope that makes sense, guys. Thank you for watching.